The world abounds with complex and puzzling systems. For instance, the stock market fuddles all manner of investors, ranging from newcomers to veterans. According to the reigning doctrine of financial economics, every market is an efficient system where the current price always reflects all the information available to investors. In this sleek environment, no one can discern any cues for predicting the market in a credible way. On the upside though, a duplex framework can debunk the myths of the stock market in decisive ways. An example involves the seasonal waves behind the monthly moves of the Dow Stock Index. The benefits of the wavy model include the ease of acquiring the information required, the leanness of the data set employed, the ubiquity of the software deployed, the universality of the experimental setup, and the strength of the conclusions at high levels of statistical significance. Ruling myths and trampled facts. We live in a world full of complex and chaotic systems. A good example concerns the stock market that stymies all manner of investors ranging from casual amateurs to gung-ho professionals. According to the efficient market hypothesis, the current price always reflects the totality of information available to the investing public. As a byproduct, no one can detect any clues for predicting the market in a trusty fashion. Instead, the market is deemed to move in an utterly erratic way. In particular, a popular myth known as the random walk shuffle contends that the price level shifts with equal likelihood and to similar extent in either direction, whether to the upside or downside. At first glance, the image of pure randomness does ring true in practice. For instance, the average investor is unable to beat the market averages such as the Dow Jones Index. While the lack of success may seem like a letdown, the truth is even worse. In actuality, the participants in the aggregate lag comfortably behind the benchmarks of the bourse. If we look more closely, the lousy performance of the actors springs mostly from their frantic efforts to beat the competition. Amid the frenzy, the demons of greed and fear prod the antsy players into making impulsive moves that are not only groundless and futile, but actually counterproductive and harmful to their cause. On the bright side though, the market displays a smattering of patterns that can be exploited by a sober person. An example concerns the seasonal cycle behind the monthly moves of the Dow benchmark. To fathom the elusive waves in a stringent fashion, we turn to the duplex method of modeling shifty systems. The sturdy framework makes use of the binomial test, the simplest and strongest, as well as safest and surest, way to profile chancy events regardless of the domain. To this end, we first transform the conceptual models of the stock market into a trio of precise templates. The formal blueprints are then converted into R code, the top choice of programming language and software platform for statistical workouts. The trenchant results serve to debunk the fable of efficiency and confirm the existence of hardy patterns in the marketplace. In short, the benefits of the seasonal model lie in simplicity and potency in sundry forms. The drawcards include the ease of acquiring the information required, the leanness of the dataset employed, the ubiquity of the software deployed, the universality of the experimental setup, and the strength of the conclusions at high levels of statistical significance. Method. To underscore the gulf between the theory and reality, we will take a minimalist approach. For starters, we use only a minute fraction of the wealth of information freely available to all comers at the most popular portal among the investing public. Moreover, the quantitative analysis employs only the simplest technique in hypothesis testing. In addition, the code required for the study invokes a tiny subset of the core functions within the R system, the top choice of programming language and software platform for data science. Precise models. According to the efficient doctrine, every asset displays equal odds of rising or falling at any stage. In that case, the current price always reflects the best guesstimate of the price level going forward. We will refer to this parity of the market as the idle model. We now take a step back and look at the big picture of the stock market over the long range. Anyone can see at once that the price level has a way of climbing higher as the decades go by. The global trend shows up, for instance, in the ascent of the Dow Jones Industrial Average from its inception in 1896 until the modern era. The index is also known by the shorthand of DJIA, or simply DJI. In view of the uprise over the long range, a variation on the theme of ideal markets asserts that the upward tilt poses the best guess going forward. For instance, the optimal forecast of the price level a month hence is the current price plus a suitable increment of the gradual uptrend. We will refer to the trending version of the efficient mantra as the drift model. Choice of dataset. The Dow Jones Industrial Average is the most popular benchmark of the stock market amongst the general public. For instance, the DJI is the yardstick of choice when the mass media around the world report on the movements of the US bourse on the evening news. As we saw earlier, the DJI in its modern form evolved from a prototype dating back to the late 1800s. In view of the long history, the use of a lengthy dataset may seem like a good idea. That might in fact be the case if the target system happens to be stable and displays a fixed set of properties. But that's not the case for us here. To cite an example of the shiftiness, the action in the stock market is tied to the fortunes of the real economy, especially over the medium term and the long range. Moreover, the economy itself has a way of evolving with the passage of time. An exemplar involves the dwindling role of the agrarian sector, as well as the industrial branch over the past century. In this fluid milieu, we ought to balance the richness of a lengthy dataset against the pertinence of a recent sample. We will use the data from Yahoo Finance, the most popular portal among the investing public. At the time of research, the records available at the site for the Dow Index stretched back to January 29, 1985. In that case, a suitable dataset for our study involves the closing values of the benchmark at the end of each month starting from the onset of 1985. Since we want to distill the seasonal cycle from the historical record, we will sample the data on a monthly basis until January 2020. In this way, we can calculate the forward returns over a span of exactly 35 years beginning in 1985. Check for null returns. The financial forum finds itself in a constant state of flux, as every asset swells and swoons with the passage of time. Despite the ceaseless heaving though, the price level could settle at the same point from one period to the next. On the other hand, our dataset does not contain any repeated values in direct succession. As a result, the monthly return is never zero. So we can ignore the prospect of a null value in assigning each move into one of two disjoint buckets, namely, to the upside or downside. Profiling the data. As we saw earlier, the Dow Index grows over time despite a series of sizable upswings and downstrokes along the way. In particular, our dataset displays these very traits as shown in the chart here. On the whole, the benchmark appears to burgeon at an exponential rate over the entire stretch. That makes sense since the yardstick reflects a simple average of the stock prices for a rolling roster of 30 hulking companies in the prime of their lives. At a minimum then, the value of the ensemble should keep pace with the march of inflation that tends to advance by a couple of % or more per year. We now profile the overall trend by plotting the logarithm of the raw readings over time. In this chart, the vertical axis denotes the log to base 10 of the closing prices. The graphic suggests that the overall trend is more or less steady. In that case, the original variable displays an exponential streak. An exponential rate of growth reflects a steady gain in relative terms, in other words, a fixed percentage on a periodic basis. This chart shows the relative shift from one month to the next throughout the timeline. Our next step involves a quantitative assay. As a lead-in, we have just reckoned the fractional changes in price on a monthly basis over the entire stretch. At each stage, we pin down the relative gain, also called the forward return, over the next period as a percentage of the current price. From the graphic, we can see that the returns vary a great deal. Despite the outspread though, the scattering pattern appears to be more or less stable, especially after the first 100 cases or so. Crafting the models. Our next step is to convert the verbal descriptions of the stock market into formal models. Two of the templates represent the efficient bromide. Meanwhile, the third model depicts the seasonal cycle of monthly returns throughout the year. We begin with the idle mockup, which declares that the market rises or falls with equal likelihood and to similar extent. Since the expected moves to the upside and downside are perfectly balanced, the best forecast of the monthly return at any stage is fixed at 0%. On the other hand, the setup differs somewhat for the drift model. The latter setup does rely in a small way on the actual behavior of the market, namely, the uptrend over the long range. For the dataset at hand, the geometric mean of the monthly gains amounted to some 0.738%. Roughly speaking, the Dow index was wont to rise by nearly 0.75% on average each month. The third and last model captures the seasonal patterns in the stock market. We will refer to this portrait of monthly moves as the sway model. This chart shows the mean return by month throughout the year. We can see that, more often than not, the average move had a positive bent. In particular, the biggest gains occurred in March, June, October, and November. Moreover, the market on average hardly moved at all during May. On the downside, the worst performance cropped up in July and August. This graphic offers a richer view of the dataset. Each box plot depicts the forward returns for a particular month. For a given column, the thick bar within the rectangle represents the median level rather than the mean value for the pertinent period. Meanwhile, each circle denotes an outlier. The box plot for each month reflects a great deal of dispersion compared to the waiver of median values throughout the year. The largest number of outliers appear in the 5th, 9th, and 11th thumbnails. More precisely, each of May, September, and November features 3 extreme values. Despite the broad scatter of readings along with the clutter, we can discern some differences in the average values. For instance, the median return for October appears to surpass those of September and November. Meanwhile, an example on the flip side applies to August, whose average gain falls below those of July and September. On the whole, the relative placement of the median values resembles the configuration of mean returns that we saw in the previous chart. Choice of average for the sway model. We could use the chain of mean values or the median levels to serve as the backbone of the sway model. For this purpose, we first check which arrangement leads to higher accuracy, or more precisely, less variation in the absolute values of the errors against the entire set of forward returns. We find that the string of median values does a better job of modeling the monthly gains on average than the chain of mean returns. So we adopt the median array as the marrow of the sway model. That is, the median value of the forward returns for each month will serve as the implicit forecast for that period. Graphic matchup of results. We now compare the 3 models for profiling the seasonal patterns. That output takes the form of a box plot of the errors for each model. Compared to the full scatter of errors, the average values of the residuals hardly varied at all. On the other hand, a graphic display can be misleading. For this reason, we turn to several forms of quantitative analysis. Precise peg of ups and downs. According to the efficient chorus along with the random walk burlesque, the moves to the upside or downside occur with equal likelihood. In that case, the null hypothesis posits the chance of upturns to equal 0.5. In the absence of further information or supposition, the alternative premise entails a two-tailed test in which the critical regions for rejection lie on the low side as well as the high end. In the current study, the number of successes, that is, the turn-ups in price, came out to 266 out of 420 trials. The ratio amounted to a little over 0.633, which exceeded the anticipated value of 1/2. More to the point, the assay rendered a p-value of 5.108 times 10 to the -8. The latter value fell well below the usual threshold of 0.05 that serves as the upper bound for rejecting the null hypothesis. As a result, we could eject the premise that the movements of the market were thoroughly random. That is, the idle model contradicted the data at a high level of statistical significance. In the case of the drift motif, the best forecast at each stage reflects the fixed uptrend over the long range. Other than that, the sloping template resembles the idling motif. In particular, the odds of leading or lagging the trend line are deemed to be equal. For this reason, the null hypothesis presumes the fraction of positive residuals to be 1/2. In actuality, the number of upturns equaled 230 out of 420 cases, thus yielding a quotient of some 0.548. The latter fraction strayed by a moderate amount from the expected value of 0.5. Moreover, the p-value of 0.05691 fell just above the threshold of 0.05 for rejecting the null hypothesis. As a result, the drift mock-up lodged within the realm of credibility. In brief, the market displayed a small tendency to rise rather than fall in relation to the prolonged uptrend. Despite the imbalance, a binomial test of directional moves showed the drift makeshift to be more or less compatible with the data. We now proceed to the sway model. The number of successes, or miscues to the upside, equaled 204 out of 420 cases. The resulting quotient came out to 0.486. Moreover, the p-value of 0.5915 proved the null hypothesis to be wholly credible. In other words, the sway model pinned down the midpoint of the movements in the following sense: the implicit forecast was about as likely to overrun as to undershoot the actual return going forward. We have just assessed the pricing models in terms of the fraction of correct calls. In particular, we proved that the idle gospel runs afoul of the reality. Moreover, the drift template was somewhat plausible from a statistical stance. Best of all, the sway model turned in trustworthy results. The seasonal template bisected the prospects so well that the fraction of positive errors came much closer to the expected value of 0.5. In short, we examined the fitness of the candidate models based on the frequency of errors to the upside versus downside regardless of the extent of the flubs. Each template was checked separately to determine whether or not it conforms to the historical record. A different way to appraise the models is to compare their performance against each other. Global odds of orientation. The trio of pricing models may be pitted against each other in a pairwise fashion. More precisely, one template outranks another if its tally of miscues undercuts its rivals. According to the null hypothesis, the fraction of wins for any model against any other should equal 1/2. Even so, we may have good reason to believe that a given model should outplay another. In that case, the alternative conjecture posits the fraction of wins to surpass 1/2. As an initial step, the drift template was compared against the idle. The null hypothesis presumed no difference in efficacy, thus entailing a win ratio of 0.5. In the previous section, we saw that the drift makeshift was wont to outshine the idle mock-up. A fitting premise for the alternative thesis avers that the former should trounce the latter with a probability in excess of 1/2. The drift model in fact bested the idle canard in 244 cases out of 420 trials, thus scoring a win ratio of around 58.1%. Moreover, the p-value of 0.000527 proved the advantage of the winner to be highly significant. The results of the previous section also suggest that the sway model should outstrip the idle version. For this reason, the null hypothesis assumed no difference in accuracy, while the alternate premise favored a fraction in excess of 0.5. A rundown of the data showed the sway template to outclass the idle motif in 244 cases, thus amounting to a hit rate of 58.1%. Moreover, the p-value of 0.000527 marked a stout level of statistical significance. The next checkup involved a similar assay for the sway framework against the drift mock-up. The former beat the latter in 55.2% of the cases and yielded a p-value of 0.01788. In this way, the cyclic template outplayed its trending rival at a respectable level of statistical clout. To sum up, the drift makeshift outranked the idle icon in terms of the odds of rising and falling. Better yet, the sway template outflanked both of the efficient takeoffs with remarkable consistency. The advantage of the seasonal framework prevailed at ample levels of statistical significance throughout the time span covered by the study. As we saw earlier, the directional moves of the market were by themselves enough to expunge the dogma of perfect efficiency. Moreover, this section has rendered similar results based on the performance of the pricing models against each other. From a larger stance, these types of appraisals may also be performed on smaller portions of the annual cycle. An example involves a marked tendency of the market to falter during the summer then advance in the autumn. Odds of intra-year waiver. In the previous two sections, the monthly moves of the stock market were canvassed across the entire timeline without paying heed to the miscues by month over the course of the year. On the other hand, we may perform similar assays of the relative performance of a couple of months within the year. For a specific example, we return to the box plot of returns for each month of the year. From this chart, we infer that the median value in the 10th box plot is higher than that of the 8th thumbnail. In other words, the median return for October outruns that of August. These 2 months in fact turned in the best and worst scores on average by way of median returns. As a result, August and October comprise the top candidates for confirming the gap in performance between different portions of the year. 2 samples without coupling. For the first test of intra-year movements, we examine the 2 months independently. More precisely, we check whether each month displays a notable tendency to rise or fall, regardless of the behavior of the other month during the same year. The null hypothesis presumes that August and October display equal odds of rising or falling. For a change of pace, consider a shaman who is so entranced by the efficient voodoo as to deny the massive evidence presented thus far. The fiend asserts instead that neither month flaunts any advantage over the other. In that case, the alternate hypothesis entails a two-tailed test. We now check the difference in performance by way of a binomial test. For starters, we find that October climbed higher in 25 out of 35 years, thus notching a win ratio of 71.4%. The corresponding value for August was 45.7%. The mismatch between the foregoing rates displayed a p-value of 0.003298. In this way, October prevailed against August at a staunch level of significance. In this assay, we examined the independent prospect of each month rising or falling, regardless of the year of occurrence. The checkup took the form of a test for proportions. From a different slant, we may also check the ratio of paired returns on a yearly basis. In other words, we want to determine whether October was likely to outshine August in the same year. Paired samples by year. The latest workout calls for a binomial test of matched pairs. A rundown of the data showed October to eclipse August in 25 out of 35 years. The upshot was a win ratio of 71.4%. A test of paired samples differs somewhat from a checkup of unpaired groups as described in the previous subsection. In the latest grilling, the p-value for the paired test came out to 0.008337. While the turnout was not as stringent as the prior result for the unpaired samples, it was highly compelling even so. In the larger scheme of things, the ratio of wins notched by a given month against another may well differ in the case of a paired sample as opposed to an unpaired batch. Naturally, the distinction also applies to the ensuing levels of statistical significance. In the foregoing contest of October versus August, the peppy month prevailed in 25 cases on its own, and exactly as often in a pairwise matchup against the droopy month. Although the number of wins for October happened to equal 25 in both assays, there was no preordained reason for the scores to be identical. In keeping with the distinct themes and objectives, the significance levels did in fact differ between the tests for the paired sample versus the unpaired grouping. To bring up a second factor, the checkup of independent samples involved a two-tailed test under the premise of perfect efficiency. By contrast, the paired grouping was consigned to the strictness of a one-tailed test as a way to acknowledge the domain knowledge uncovered thus far. Both types of appraisal yielded hefty levels of statistical import in confirming the vantage of October over August. Special features of the assay. The foregoing forms of appraisal differ from the conventional method for vetting the disparity of a couple of groups. More precisely, the usual practice relies on a rough and ready scheme based on the t-test along with its iffy assumptions. All too often though, the constraints behind the latter test are invalid in the real world. Even so, the disdain for inconvenient facts is spotlighted by the massive studies trained on the financial forum including the stock market. To be precise, a t-test of unpaired samples stands on a couple of shaky premises. The data from both groups must be normally distributed as well as display the same variance. In a similar way, a t-test for a matched sample assumes that the difference between each pair of observations conforms to a Gaussian ogive. By contrast to the usual spree of hand-waving and windy denial, the procedure followed here has invoked the binomial test. For the current study, the only requirement to speak of concerns the independence of movements. From a different angle, the latter condition forms the pith of the efficient doctrine. For this reason, the premise of independence is not merely admissible, but in fact obligatory for an assay designed to evaluate the orthodox canon. In short, the duplex framework has no need for extraneous crutches. By contrast, the t-test draws on a false image of the stock market, namely, the hegemony of the normal ogive. On the bright side, the binomial test upholds a sound alternative based on an honest approach to modeling. In this formula, the lack of arbitrary constraints plays a vital role in the leanness, elegance and robustness of the procedure. To wrap up, an appreciable gap in performance arose between certain months of the year. In particular, October was prone to outpace August of the same year at a persuasive level of statistical clout. In the previous assay, an independent sampling of the divergent months also confirmed the lopsided odds of rising versus falling when the moves were not paired up by year. In these ways, the existence of a noteworthy gap between a couple of months was by itself enough to scrub the whitewash of efficiency at an ample level of assurance. Conclusion: Duplex models can portray complex systems with the utmost of simplicity, clarity, and efficacy. The advantage of the binomial framework shows up, for instance, in purging the plethora of myths and misconceptions in the financial forum. An example concerns the dictum that the stock market lacks any recurrent patterns. According to the sweeping doctrine called the efficient market hypothesis, every market is so sleek as to absorb every scrap of information with perfect wisdom at infinite speed. In the absence of further clues, the price level going forward has to move in a completely random fashion. In particular, the chance and scope of an upturn must equal that of a downstroke. A direct outgrowth is the random walk charade by which the shifts in price follow a normal distribution centered on the mean value of zero. The aimless behavior of the market has been dubbed here as the idle model. A variant of the idle mock-up concedes that the stock market displays an upward tilt over the long range. The upshot is a series of moves that follows a Gaussian ogive with a mean return defined by the gradual uptrend. The trending template has been branded as the drift model. As an alternative to the bland schemes of the efficient dogma, the sway model takes account of the seasonal waves in the marketplace. More precisely, the average return may well depend on the month of the year. This portrait of the market is based on real data, as well as common sense rather than glib conjecture mashed with sheer pretense. In other words, the cyclic approach requires no forced assumptions regarding any aspect of the market's behavior. For instance, there is no need to deny the evidence and insist instead that the returns must follow a normal ogive. The trio of pricing models was assessed by way of the binomial test, the simplest and strongest of all statistical assays. The results proved the idle canard to spurn the data with extreme prejudice. On the other hand, the drift mock-up was more or less consistent with the reality. Best of all, the sway model was fully aligned with the facts. In this way, the study confirmed the existence of seasonal waves in the marketplace by way of monthly returns on the bourse. The stock market is the epitome of complex and chancy behavior in the modern world. For this reason, the bourse provides a choice foundry for crafting trenchant techniques to model knotty systems and resolve tricky problems. From a formal stance, the crux of the duplex framework lies in the binomial probe, the most basic tool in statistics for checking presumptions and drawing conclusions. The two-tone method offers a medley of benefits ranging from the clarity of concepts and ease of usage to the soundness of inference and sureness of conclusions.